Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. Paul Winkler. Why are you laughing, Paul? During the break, I was having a conversation with a couple of guys I work with. And want to know what they thought I should talk about. You know, because a lot of times they'll get the phone calls. They get phone calls, people's questions. They'll come in and say, hey, can you guys... Oh, one was embarrassing. One was really embarrassing because it was a person that used to work with us. From what I'm told, they were asking about buying a single stock. And I was like, did you not learn anything? It's just, sometimes, you know, as much as I try to teach, sometimes it doesn't settle. I try. But they were asking about a single company stock. And of course, as I always tell people, you know, individual stocks, you have non-systematic risk, tremendous risk that company won't be around. Look at the Dow companies and look at how many of them survived from the 1930s or even in the last couple of decades, how many have gone away. I mean, it's just companies come and go much more rapidly. There was a study that was actually done, and what they were looking at, it was a study that was looking at portfolios of, I'm trying to remember what it was. I think it was something like 40 or more stocks. And they were looking at the returns of that versus portfolios. It was like 20 stocks or something like. And the point that they were making is this, was that the returns were like 6% lower with the lower number of companies. And then the risk was like 12% higher. It's like a standard deviation that was 12 higher. So in essence, you got less return with more risk with fewer companies. And the interesting thing they were making, the point that they were making was that over the period of the study was due, I do remember this, the study was done over two 30-year periods that were back-to-back with each other. And they were looking at 2 to 30-year periods. And the point that they were making was that the returns were way the heck lower on lower numbers of stocks in the portfolio. The returns were lower and the risk was higher. But the interesting thing was the stock market the risk of the stock market in general was no higher. So in other words, if you look at the stock market volatility, it hadn't increased, but individual stock risk had increased. So in other words, companies come and go much more rapidly than ever before. So it makes even less sense as time goes on for, as we think about investing in individual stocks. It doesn't make sense. It makes less sense now than it ever has. And you would think that, people got it because, so often you hear these horror stories of how people lose everything. But it's just this gambling spirit that we find with people that, I want to make it big. And it's like, maybe are they behind in retirement savings? They just want to hit it big so they can make up for lost time. Maybe that could be part of it. There's also a dopamine hit, when we look at brain chemicals and the excitement that we get, and we get dopamine hits from gambling. I mean, it's just well known. Now, so that was one thing. If somebody is asking about an individual stock. Another thing somebody asked about was XRP, Canary XRP. It was an ETF that was issued. And I said, somebody was asked, so when we're dealing with crypto, I always tell people it's not an investment. Crypto is not an investment. As much as they like to tell you it's an investment, it's not any more than Beanie Babies were really a great investment, or artwork you can think of as an investment. But the reality of it is it goes up and down in value. Anything that's a commodity that goes up and down in value based on supply and demand is not an investment. We have to have a cost of capital, as I always like to say. With real estate, it's an investment because they pay rent. It reminds me of a meeting I had earlier this week. I may come back to that. Real estate. It was a really interesting conversation I had earlier in the week. But that's one thing that you could look at that as an investment because there's a cost to use your capital. There's rent to use your property. With companies at stock, you get paid earnings to use your money. With CDs or fixed income investments or bonds, you get paid interest to use your money. Now, in this particular instance, they're asking about this particular thing, and there was all kinds of hype about it. And I thought for sure when I was going to go out on the internet, I was going to look this up, that there was going to be this flaming high rate of return that was attracting people and causing them to want to call and ask about investing in this thing. So we're always telling people not to do this, but I don't know how many people actually listen to the radio show or listen to the podcast that call. But they were talking about doing this, and I looked at the chart, and I said, Michael, in the office up here in the Goodlettsville office, I said, have you seen the chart on this thing? And he goes, what, impressive? And I says, yeah, impressively bad. And it's just like a ski slope downward. And it's just down, 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 down. And one of the guys in the office goes, Scott goes, he goes, well, you always say buy low. And I said, well, that's under the presupposition that you can sell high later on. This doesn't make a whole lot of sense. But this quite often happens. People get excited about stuff and they hear things and they get hyped up, and then they buy and it loses money and they go, oh, that wasn't such a good idea. But it doesn't stop them from trying it again, unfortunately. You wish that would be the case. Not necessarily, it doesn't happen. Another thing that was brought up, SpaceX IPO. That was another conversation that people brought up. Hey, what about this? SpaceX IPO, Elon Musk, it's kind of exciting. And you can see where people would get hyped up about something like this. Seems like everything that Musk touches, he seems to do a pretty good job with things. But, you go, wow, he's done a really good job. And people that might have gotten involved in maybe Tesla early on would have done really, really well. But it wasn't an obvious thing that he was going to have the success back then. So you might have had the opportunity to buy something like that, but you wouldn't have known whether it was going to be successful because you didn't really know this guy had no track record. You didn't know how he was going to do. So therefore, that it would have sold for a very, very low price because it had no earnings, had no history, so you have a very, very low price and, you might have been able to buy it for a song and a dance. Now, when you see something coming out like this, you go, oh, wait a minute. There is a guy with a track record. And remember, I've often talked about what companies sell for historically for every dollar of earnings. You've probably heard me say this a million times, 16 times. That's the S&P 500. For value stocks, about 10 times. And this will vary from time to time, so don't look out there and try to look up these numbers. But you will typically see that somewhere in that neighborhood that I pay $10 for every $1 of earnings. Well, what are they guessing that this thing is going to come out for? 80 times. That was something I was looking at AI to see what if there were any kind of estimates, and they were pulled from, I think it was Motley Fool. They actually pulled this data from what they thought it was going to be selling for. And you go, wow, wait a minute. This is not selling for a bargain price, waiting for somebody to pick it up and just make a mint on it. It's selling for an incredibly high price. In other words, their earnings are going to have to be spectacular to justify the price being paid. Because you have well-established, liked, known companies selling for a tiny, tiny fraction of that. So recognize that's how markets work. What will happen, and it may end up being higher than that. It just depends what the demand is. And as you can imagine, any company trying to sell an IPO stock, initial public offering, wants to get as much as they possibly can, for that stock, because they're going to be giving away the earnings. So they're going to try to get as much as possible, and that's how the price gets set. So what we know from research, because there's a tremendous amount of research on IPOs. I remember seeing it many years ago, and what they found in the research was that typically they lose money in the first 9 months. Well, why would that be? Why is it that IPOs tend to lose money in the first 9 months? And I don't know, that data may be a little bit different now, maybe a different amount of months, but they typically do. And the reason is this, is that investors get excited about something. They hear about an IPO, they want in on the ground floor, and they have a tendency, because they don't really know what they're buying. There's not a whole lot of information. You're buying an IPO, you're buying based on what you think earnings might be in the future. You don't really have anything to go on. It's just conjecture. And people have a tendency to overpay, is what they found. So in the academic world, one of the things that I'm looking for is when I invest in funds, I don't want them engaging in IPO purchasing. I don't want them in that area because of that. I want to make sure that we have a track record of earnings. I want the companies to have been out for a while. Then at least I know what I'm getting into. I know what I'm buying. I know the earnings that I'm buying into, because now the company information's been out there. The public, well-informed investors have been able to rifle through the earnings reports and the sales reports and all of the data on the company. And that way we get a better idea whether I'm getting a fair price when I buy it for every dollar of earnings that the company's likely to have. And that way we have some kind of a semblance of an idea whether this is a proper deal. If I had, think about it this way. This metaphor or this analogy just came to my mind. Think about, let's say if you were going to buy a piece of property, you were going to buy a house. What's the first thing you're going to do? You're going to go look at comps. You're going to look at comparable properties that have sold in the past, 3 months, 6 months or whatever, just to see, hey, per square foot, am I getting a good deal? Is this a price that makes sense based on what real estate is selling for in my area? And that gives me a warm fuzzy that I'm not getting ripped off. I'm not paying too much. So that's what I'm going to be looking at, is that type of thing. If I'm investing in a company, that's the same thing. I want to know what the earnings are likely to be. I want to know what the assets of the company are likely to be. I want to know what the sales are, what the sales projections are, so that I'm not overpaying for the company in question. And that's the problem you run into with IPOs. You just don't have that information. It's like private equity. I've been talking about that. When I'm dealing with private equity, I don't really know what the company data is because it's private. And that's the problem that you run into. You don't really know this kind of stuff. And, so that's one of the things I tell people, really, really be concerned and conscious about this type of thing. Another thing that I've been seeing is, I've been seeing a lot of articles like this. Investors are growing concerned about Trump's new 2 to 3 week timeline on Iran. Now, number one, when I see this kind of thing, investors are growing concerned and Americans are getting impatient. There's part of me that goes, isn't that the media? The media is, they're just like, oh, they're going to go find people that are scared. They're going to find people that are concerned, and they're going to interview these people because why? Because they know that it engages people's interest. You will read an article that has a headline that's scary. We know that. The media studies show it. The media studies show that engagement goes up when the news is negative or potentially negative. Why? Because when news is negative, I can read the article and maybe I can do something to protect myself from whatever negative or bad thing that could happen. If the news is positive, there's nothing to protect myself against. So very rarely will you ever find a bunch of positive news in any newspaper or magazine. Now, that's especially the case, right, when it comes to Trump, because it's like there's always something that, there's something being said or something happening, and the media likes to tear them apart. But the point I want to make is this, is with this headline, investors are growing concerned about this 2 to 3 week thing, right? They get nervous because, well, how long could this go on? And what they don't recognize is that stock markets respond to new information as soon as it comes out. So if somebody is getting concerned, recognize that, for example, an area of the market that was expected to be hit hard with all of this stuff, large U.S. stocks especially, But, in other international, some of the international markets, the larger companies and things like that, they already went down in anticipation that this could go on longer than what was expected. They already went down because of the expectation on how this would affect earnings. So if somebody gets nervous, an investor gets nervous and sells, they're selling to somebody that's willing to take that risk. So when information comes out that's negative, what has happened to risk? It's increased. What happens when we have increased risk is increased expected return. Because investors don't want to take risk without being compensated for it. That's the whole idea of investing. Take risk, get compensated for it. Don't take risk that you're not expected to get compensated for. That's why it doesn't make sense to buy individual stocks. You're taking risks that there's no payment for. The expected return on one company isn't higher than another company. May it be? Can the return be higher? Yeah, it can, but it's luck that causes that. We don't want to depend on luck. But what happens is that people will invest in something and they say, oh, gosh, I think that this is going to be a lot of risk. And they'll say, I'm not going to pay you as much for that. So that if something bad happens, I don't have as far to fall, or I have money, there is more money to be made in the future as things turn around. I've got to be compensated for that. So historically, if you look at the riskiest periods in time, or the periods in history where things look the most bleak, think about after October 19th of 1987, things seem bleak. Anybody that bought stock, on October 20th, that had to, they were taking on risk because you didn't know what was going to happen. Anybody that bought stock after 2000, 2001, 2002, it was a scary time. You had 9/11. We didn't know what was going to happen. We didn't know whether the war was going to spread, whether terrorism was going to take root in America. You look at 2008 and you go, wow, banking crisis. Our whole banking system could be falling apart. That's scary stuff. We don't know what's going to happen. And anybody that took a risk and invested at that point in time, there are people out there saying, it's never going to come back. I remember this one guy, he was Maria Bartiromo's show. It's never going to come back, Maria. It's going to be down. And you think, wow, this guy is a really well-known investor and he knows his stuff. And he's saying it's never going to come back. Anybody is willing to take a risk and invest during those types of market times, they're wanting to be compensated, so they'll pay a super, super low price. And when markets came back, they were richly rewarded for it. So this is how markets price things. When things get scary, they go down. So somebody that says, a market publication that says investors are growing concern, well, that leads me to think that they're probably thinking of selling. And typically investors have a tendency to sell at market lows. They buy high, they sell low, and they shoot themselves in the foot. One of the things you have to be very, very conscious of as an investor is to just tune this stuff out. You don't know what's going to happen. As long as you're diversified, as long as you might be rebalancing during times like this. Stock markets go down and, your bonds hold value. So you sell some bonds, you buy some stocks. And different markets went down more than others, like large U.S. stocks went down a lot. And you may be rebalancing back into them. You might have a little bit more in those, and that's the management of a portfolio. But you're not doing it based on predictions of what's going to happen next. That's the big key for investors to get. Don't try to predict the future. Don't make moves based on predictions about the future. Market timing doesn't work really well. You don't want to do it. Bad for your wealth. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. I was talking about something, and I forgot to mention this, but I was talking about this this thing that I had heard, investment person talking about, hey, we want a full range of things that we can invest in, and you don't want to be hampered by anything. So, and I knew because I knew what the person was doing, that they had annuities that they were trying to sell. And they were using them as a bond replacement. I was talking a little bit about this, and I've seen there was a video out there that was done, and it was a well-known investment person, commentator, kind of like a consumer advocate type of person, talking about annuities, not liking them, having problems with them. And the guy that was basically picking on the point of view being presented was saying, well, you can use them as a bond replacement, and they could have higher returns than bonds in an investment portfolio, and you ought to do that. And I was making the point in the show here that doesn't make any sense. Because when you manage an investment portfolio, those of you that didn't hear it, let me explain why I really just shake my head when I hear this kind of garbage from investment people. They're saying use an annuity as a bond replacement. So if I have half my money in stocks, let's say I have a portfolio of half stocks and I have half bonds. And let's say that I am going forward and I'm taking income from my portfolio. In a year that stocks do well, I'll take money from stocks. And you're going to break that down. You're going to have large companies, small companies, value companies, growth companies, U.S., international, so on and so forth. And, like let's say that I'll go through years. Let's say in 1998, you're taking an income. Large U.S. stocks do better than anything else. So I take money from large U.S. stocks in 1998. 1999, emerging market stocks go up 71%. So I'm going to take money from the emerging market stock portion of my portfolio. I'm not going to touch my bonds because my stocks are doing pretty stinking well. Year 2000 rolls around. And you go, wow, that was when tech stock bubble, that started to burst. But value stocks went up 10%. So I'll take money from that. I'm still not going to take money from my bonds. 2001, small cap, value stocks especially, up like 30%. So I'm going to take money from there. Now, 2002, you literally had only one asset category in the stocks that actually went up, which was international small. But it didn't go up as much as bonds did. And you had bonds going up like 16%. The intermediate term bonds went up 16%. So I'm going to take money from that area in those types of years. In 2003, you're going to take money from small value U.S. stocks. That's the area, and so on and so forth. So in any given year, you'll have one thing that does better than another. Well, the idea being pushed out there in the investing community is just, take instead of bonds, because, if you take the past, 10, 15 years, bonds haven't done that well. And the reason that intermediate bonds hadn't done that well is because what happened to interest rates? Well, people that have been thinking about buying a home would tell you, scream, interest rates went up. You could get a house at a 2% mortgage. Now it's, 6% mortgage and plus 6% plus. And when interest rates go up, bond prices go down. And so the longer 10, 15 year return of bonds hasn't been that great for that particular reason. But, mark my words, what happens if you go back through history and you look at when you have big market downturns, what's the first thing you typically hear? Is that interest rates are going to be reduced to revive the economy. And when interest rates go down again, that's when bond prices spike. So that's what happened in 2002, 2008. You look back in history, the 70s and so on and so forth, you'll have these periods of time where interest rates jump up or go down, and bond prices jump up when stock markets go down. And that's the reason you do that. Well, the thinking is, and then what you'll hear people say is, well, you could get a higher rate of return on the annuity. And you get a higher rate of return and going forward than you would bonds. Well, who's to say you're going to get a higher rate of return? Number one. Annuities were paying terrible rates of return too during that period of time. Why? Because what are insurance companies investing in? This is something I talked about in the show. I walked through the investment portfolios of the big insurance companies. And I think I chose three or four different insurance companies. And I pointed out that the bulk of their portfolio was in bonds. So how are you going to get a higher return? Now you got another middle person, the insurance company. But they'll promise a higher rate of return. So that's what you need to do is buy this annuity. And you think about, well, what will happen if I needed to pull my money back out? Well, the insurance company pays a commission to the advisor, and you often have what is called a back-end surrender penalty. Now, you might be able to get access to some of your money without any kind of penalty, but if I need to rebalance, I don't know how much money I'm going to need to actually rebalance my portfolio. In other words, if stocks go down, I'm supposed to have half my money in stocks, half my money in bonds in my example, and now stocks are taking up only 40% of my portfolio, I might have to take my bonds now are taking up 60% of my portfolio. Well, now I've had a 20% difference in the amount of bonds that I've got to pull money from. And now I've got to go and sell it and do this. And now I've got a back-end surrender penalty. That's not cool. Number one. Number two, when is it? And the type of products, I was talking to somebody about this, and I thought I probably ought to explain this. What type of products are being pushed as a bond alternative that are supposedly supposed to have this higher rate of return? Index annuities. Now, why in recent years would index annuities had a better rate of return than bonds? Because they have a little bit of the benefit of the stock market because they're indexed the S&P 500. Now, they cap your returns so that long run, the rate of returns, basically these products are about the same return as bonds. I mean, it's not that great. And I've seen several studies out there that just point out that the returns have been pretty abysmal, really in these products. But in recent years, and this is how they pull you in. They look at recent history to try to pull you in, say, hey, look what this product would have done if you've been in there over, and they'll have some short period in history. Now, here's the thing to keep in mind. What are bonds there for? To protect you from what? Big market downturns. We haven't really had, and you can look at 2022 and say that was kind of a bad market for the S&P 500, but most areas of the market were actually not that bad. Not nearly as bad. Now, value stocks went down, small value stocks went down, but they went down only by 3%. Now, I'm talking about major downturns that affect a lot of areas at the same time. You have to go back to 2008 to see something like that. And then back to 2002, before that. Here's what happens with these products when you have big market downturns like that. The typically rate of return is like zilch, nothing. So when you rebalance the portfolio, unlike 2002, where bonds shot up 16%, and 2008, where the right types of bonds shot up 11 to 13%, you have basically no rate of return. You're not pulling from something that's gone up in value when you pull money from the bonds to buy the stocks. You're pulling the money from, because remember, this type of annuity is predicated, the results are predicated on the return of the stock market. If the return of the stock market's bad, you're not going to see return. So it just boggles the mind that somebody is going to sell this as a bond alternative. And especially when you think about how they tend to perform when that happens. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.